And welcome to the webinar on international taxation in developing countries organized by the Center for Global Development. My name is Sanjeev Gupta and I am a Senior Policy Fellow at the Center. The focus of our discussion today is a challenge that low-income countries face in raising revenues because of aggressive tax planning by multinational corporations. Developing countries are not alone here. Even advanced countries have to deal with the tactics of multinational enterprises. What makes low-income developing countries more vulnerable is their weak administrative capacity. Fortunately, revenues from corporate income tax in these countries have held up at around 3% of GDP, which is about 1/5 of the average tax take of 14% of GDP in these countries. This is despite the fact that developing countries are losing more revenue as a result of tax avoidance activities of multinationals. The IMF has estimated that this loss is at around $200 billion annually, which is about 30% more than the advanced economies. If revenues from corporate income taxes were to fall and not grow with expanding national output, low-income developing countries would have difficulty in meeting their social and infrastructure needs going forward. So our discussion today should not overlook the fact that because of the COVID pandemic, revenue position of these countries has worsened by 2 to 3 percentage points of GDP in 2020. There is a chance that the pandemic will leave a permanent mark on the economic structure of these countries with important implications for the tax base. Experience from the financial crisis of 2008-2010 suggests that severe output contractions are associated with falling tax compliance. What this means is that tax revenues in these countries will be significantly affected for a number of years. Another important issue we will discuss today is the taxation of the growing digital economy. While major international tax initiatives are seeking to address this issue, there is a question as to whether the proposed measures are practical for developing countries. An expansion of the digital economy, which has received an impetus from the COVID pandemic, should be seen as a growth-enhancing activity. How should it be taxed without impeding growth and benefits that digitalization imparts to the society? So before we proceed any further, I would like to take this opportunity to briefly introduce today's speaker and members of the panel. Peter Mullins, who will make a short presentation to introduce the issues, is a former IMF Deputy Division Chief. He is an expert on tax policy issues and has provided tax policy advice to more than 50 countries. Peter has also worked for the Australian government in various capacities. Ben Dickinson is the head of global relations, and he's one of the panelists at the development division of the OECD Center for Tax Policy Administration. In this role, he is responsible for ensuring that developing countries participate in OECD tax standard setting work and receive capacity building support. Mr. Dickinson has also worked for the UK government as a senior government specialist. Susanna Ruiz is the tax justice policy lead for Oxfam International, and she focuses on tax and inequality issues at the global level for Oxfam. We are very glad that she was able to join. Alex Cobham is the Chief Executive of Tax Justice Network and a Commissioner for the Scottish Government's Poverty and Inequality Commission. He has been a researcher at Oxford University, Christian Aid, Save the Children, and Center for Global Development, and is an author of 2 books. And finally, Antonia Strache is an international tax advisor in UK's Foreign, Commonwealth, and Development Office. So as Hannah said at the beginning, I'll appreciate very much if the panelists were to restrict their remarks to 7 minutes each. As for the audience, they can channel their questions through tweet at CGDev, hashtag CGDTalks, or email at events@cgdev.org. So let's start. Can I request Peter to start his presentation, please? Thank you.
Thanks, Sanjeev, and good morning to everyone. We'll just wait for our presentation to come up. So what I'd like to do this morning is give you a brief overview of some of the international tax issues for developing countries, talk a little bit about some of the tax initiatives, and then how developing countries might respond. This is based on a paper that I prepared for the Center for Global Development last year. So I want to begin by talking a little bit about the challenges that developing countries face when they think about international tax. The first is developing countries obviously need revenue to meet their fiscal needs, and in particular in financing the Sustainable Development Goals. The IMF estimates that the additional spending to meet the Sustainable Development Goals is around 15.4% of GDP, with at least 5% of that coming from domestic taxes. In addition, as Sanjeev said, many of the developing countries have low tax to GDP ratios, often below 13%, which is considered the minimum to achieve significant growth and development, let alone to meet the Sustainable Development Goals. Another challenge is that developing countries, like most advanced countries, need to address aggressive tax planning by multinational enterprises. Obviously, in many developing countries, they don't have anywhere near as many multinational enterprises as in advanced countries, but they do have a significant impact on the economy and in some cases are very important sources of revenue for the government. As Sanjeev said before, the revenue estimate for developing countries is around $200 billion lost due to tax avoidance. A complication in all of this, of course, is that many developing countries also offer investment incentive for multinational enterprises, and they usually do that to attract foreign direct investment. So there is this issue about wanting multinational enterprises to pay tax and to stop their aggressive tax planning, but at the same time, many developing countries actually give these enterprises tax exemptions or other types of tax incentives. So that's a complicating factor in the discussions. The other issue just to touch on, of course, is the digital economy and that the issue around the taxation of the digital economy, which is a concern for developing countries as it is for advanced countries. If we can go to the next slide, thanks. So what are some of the obstacles that developing countries face? Well, one of the most obvious, one of the obstacles is this question of having adequate international tax provisions in the law and a clear understanding of how those work. Often you find in developing countries that their laws are very old, they haven't been updated very often, and so they don't have provisions that deal with today's international tax issues. But they also don't have a clear understanding of how those laws work. They don't often understand why laws need to be updated, and even if they are updated, exactly what some of these laws mean. Another concern or obstacle for developing countries is low administrative capacity. That capacity includes, their ability to administer international tax rules and also their ability to audit and monitor multinational enterprises. Often in many of these countries, they just don't have the experience in dealing with multinational enterprises. Or alternatively, they lack critical mass, especially in the smaller countries, to be able to deal their normal work and as well as having to deal with some of these international tax issues. A good example is transfer pricing. Many of the countries I go to have transfer pricing rules. Some of them have transfer pricing regulations, even explanations of how those rules are to operate. But many of them have done no transfer pricing audits, for example. So they have the rules, but they're not quite sure or reluctant to fully implement those rules. Another factor is that few of the countries have double tax treaties. Those that they are often entered into for political purposes, and generally double tax treaties don't favour developing countries. One of the reasons for that is that there's often lower withholding tax, dividend withholding tax rates in these treaties. And as we all know, that much of the investment comes from advanced countries into developing countries rather than the other way. And so therefore the dividend flows are out of the developing country to the advanced country. And so any reduction in dividend taxes generally favours the advanced country over the developing country. We can go to the next slide, thanks. So I'm not going to touch on I'll just touch on these very briefly, what some of the international tax initiatives are. Obviously, the most obvious is the G20-OECD BEPS project, Base Erosion and Profit Shifting project. Arising out of that is 15 action items. 4 of them are what we call minimum standards, 10 common approaches, including a multilateral instrument for amending double tax agreements. And of course, the other outstanding issue is digital taxation, which we'll talk about in a moment. The action items cover a range of issues, including issues such as transfer pricing, treaty shopping, country-by-country reporting by multinational enterprises, harmful tax regimes, and so on. Arising out of the BEPS project is the inclusive framework, and the idea of the inclusive framework is mainly to monitor the implementation of the BEPS action items. But one important element of it is that it's brought in both advanced and developing country representation. So I think now there's around about 139 country members, and I'm sure Ben can update if that number has changed. So it's good that developing countries are able to participate in that process, or at least have been invited to participate in that process. The inclusive framework is also looking at the digital taxation issues, and at present there are 2 proposed responses. One is what we call Pillar 1 and Pillar 2. Pillar 1 is around new profit allocation rules, so allocation between countries, and nexus rules, so whether or not there's a taxable presence in a country. The other pillar is around global minimum tax, which is, both of them are still being developed. There is one other digital taxation measure that is around, which I haven't added in my slides, is the United Nations Model Tax Treaty. There's proposals to amend that to try to deal with digital services. Next slide, thanks. The inclusive framework complements some earlier OECD initiatives, including the Global Forum on Transparency and Exchange of Information, and also the Multilateral Convention on Mutual Assistance in Tax Matters between tax administrations. There are a number of unilateral tax initiatives. I'm not going to talk about these in any depth, but just really to flag that while there is work going on a multilateral basis, there is also countries are taking their own initiatives, in particular around the taxation of digital services. These initiatives, some of them impact directly on developing countries, such as the EU's blacklisting of certain non-cooperative jurisdictions, while the other measures may impact on developing countries in an indirect way. So if we can go to the next slide and have a look at the question of how should developing countries respond to these international tax developments. I think the first comment to make is that the response should take account of the developing countries' realities, for example, their administrative capacity. And we also need to be aware of each country's unique circumstances. To give you an idea is that recently, as I said before, I've been working in Pacific Island countries and reviewing tax reform in Pacific Island countries. And one of the things we talked to them about was how are they responding to international tax issues? And I think the response we got was, look, we've had really good training on the issues, but we really don't know what they mean for us. Like, what do they practically mean for us, and what should we practically be doing around these international tax issues? Another example is in these countries, some of them have been listed as being non-compliant or non-cooperative by the EU. And some of them are looking at, for example, introducing territorial taxation regimes. But again, they're not really sure how complicated it will be, what the costs will be, what the impact will be. So they're thinking about making changes without really thinking through the consequences because they just don't quite understand. So what are some of the potential reform options? The first is to design a simple, clear and comprehensive international tax rules and make sure these are included in domestic laws. For example, making sure that they have permanent establishment rules that are consistent with international practice. Another measure could be limiting deductions for interest expenses and other related party payments. These are kind of fairly simple measures and fairly easy to understand. Another measure is ensuring comprehensive withholding taxes on payments to non-residents. So, for example, covering management fees and technical service fees. One option, which is a bit crude, but would certainly raise revenue, is a minimum corporate tax. And some countries already have introduced that. And of course, that's something that is being looked at as part of the digital taxation debate. Countries also have to look at the role and design of tax incentives. Even though I know countries want those, it's really important that they are being assessed. Another recommendation is around being cautious about double tax treaties. It's really important, I think, to have a tax treaty policy so that as developing countries go into negotiations, that they know exactly what they're getting into and also have a clear policy of what they want to do. And also taking time about adopting the multilateral instrument because there is, seeing what happens with other countries. We go to the next slide, thanks. Obviously, we've talked about a lack of capacity, so it's important they develop international tax policy and administration capacity. It's also good that developing countries participate in the inclusive framework, but I think they should think about making the minimum standards a priority at this time, and even think about regional responses focused on developing countries. In terms of digital services, I think they should wait and see what the development of rules on the international stage, but there are things that they can do around VAT, for example, to better tax some of these services. The last thing I want to mention is that while international tax issues are important, they shouldn't distract developing countries from addressing more pressing domestic tax needs. For example, ensuring that they have an effective VAT rate. And that's the message I got from some of the developing countries I visited recently. They said that they would rather focus on domestic tax issues at this time rather than focusing too much on international tax issues. Thank you.
Thank you, Peter, for an excellent presentation. You have really set forth the key issues. Let me invite Ben, mainly because OECD is in the center of all this debate on these issues. And so based on what Peter described, what considerations in the area of international taxation would you view as priority for low-income developing countries, given their administrative capacity and current resource needs? Ben.
Thank you, Sanjeev, and good morning, good afternoon to everybody. Let me start by Peter's last point, which I think you're really raising a fundamental question: does international taxation actually matter for developing countries, given competing domestic concerns? And I think the question that is often put to us is, does the international tax tail wag the domestic tax dog? And there are any number of answers to that question. You could cite the universal benefits of the tax transparency agenda that's been taken forward by the Global Forum. You could cite, as we've heard, the dependency of developing countries on corporate income tax. You could say that because of the current crisis, the tolerance for tax avoidance and tax evasion is at an all-time low. But I think just in case, what we feel is important is that developing countries situate the international tax agenda in their country level planning. And that's why we're particularly keen to see the proposal for medium-term revenue strategies to really take hold in developing countries, because that's a way to ensure that international tax priorities are situated correctly amid a number of other domestic concerns. So let me say a word about the current negotiations and what we hear from developing countries about the two pillars that Peter has already outlined. And as he said, 139 countries, now just about half being what you might call lower capacity countries or lower income countries, are debating the digital question with a deadline of July for the G20 to come up with at least the political solution. So the heart of the digital question is what you do about taxing big companies when they don't have a physical presence. And as Peter says, the crux is this profit allocation method, which is named amount B in our jargon. And developing countries have really, in the last few years, really pushed to capture as many companies as possible, but they're kind of shifting their emphasis now because there's a realization that a very high profit threshold still captures a huge amount of global profit. So they're shifting their focus, and really is from that amount, how much will each country get, particularly small countries looking at this nexus threshold. So they're really moving their attention there. They're very keen on simplified measures under so-called amount B. This is this fixed return. And there's a debate about what the scope of that work would be for routine functions, and that's ongoing. They certainly see the need for tax certainty, and we're coming to terms with difficult discussions about mandatory binding arbitration, but on the profit allocation method work, which I've set out, we seem to be coming to the consensus of the need. On the second pillar, developing countries are strong believers in this idea of a global minimum tax. Now, where the pressure points are is that they want the rate to be high enough to strongly disincentivize profit shifting. Now, that is clearly a political issue about where the rate falls, and that's the subject of the current negotiations. But they're also very keen to make sure that the so-called rule order about who would take the tax back from tax base eroding pavements if these are not taxed in the right place. So that is a very critical issue. Let me say a word about other things in response to what some of the things that Peter has said. The minimum standards are all very well, but there are a range of tools in the BEPS package that are of direct relevance for developing countries, and we find that the upgraded package of transfer pricing work is a concern and of relevance to all countries. It's not a minimum standard, but it's where most low-income countries, the 50 or so that we work directly with our capacity building work, find of particular relevance. As Peter says, the majority of low-income and middle-income countries that we work with are very attracted by the interest deductibility work. They see that as a massive issue in all countries, and they see it as relatively simple to implement. I think the topic of tax incentives is going to be continue to be very tricky. Now, the global minimum tax might take away the need for all tax incentives, and that's the hope. But let's not forget the kind of political economy of how these are granted. And it is often the case that a tax administration or a Ministry of Finance, they might be the last people to hear about a tax incentive granted by another ministry on a foreign trip to meet an investor. And so I think that will continue to be a huge source of tension, and where we and the IMF and the bank and the UN have all put quite a lot of attention. Maybe I could end by saying a bit about natural resource taxation. I think we're shocked by the state of natural resource taxation, or maybe the lack of it. And we think the international response is quite weak. And some of you may have seen in recent days the press on Mongolia, which alarmingly has just issued its first ever transfer pricing assessment with a 1.5 billion or thereabouts in assessment. And I think this tells you everything you need to know, that the amount of money at stake is eye-watering. But if you get these things right, the returns for domestic revenues are enormous. So let me, I'll finish there, Sanjeev, and very happy to come back on some of these issues later.
Thank you so much, Ben, for your insightful comments. I think they're very helpful. They'll set the tone for the debate that we have subsequently. Let me now turn to Susanna. You've been focusing on tax and inequality issues on behalf of the Oxfam. What aspects of the current regime concerning international taxation you find unfair for developing countries? What changes would you make to make the system fairer? Thank you, Susanna.
Thank you very much, Sanjeev, and thank you very much for the invitation for taking us here to this debate. Let me first say that this discussion about the reform of the international corporate taxation was already very important for developing countries before the pandemic, and we've been very active. And now very active in the process to try to change the design of some of the reform in the interest of developing countries. But it makes even more sense at this moment. For example, just in Latin America, the level of tax evasion for corporations and individuals is 2 times bigger. The entire fiscal stimulus packages that have been activated in the region. So, I mean, if it was important before, there is no way. It's just unacceptable that we don't address it now in a way that is ensuring that developing countries are going to retain the level of revenues that they legitimately produced and that have been generated in their territories. And second, in a way that this is also going to have a huge impact in not increasing inequality. And that's another element. So when we're hearing that taxation, when we're hearing that some of those tax reforms need to incorporate also the element of growth and not be undermining the growth in this context, this cannot, I mean, separated from the social elements of the social impact also for taxation. And we've seen in the past that the response from the pandemic, from the different crises, was to increase the burden on households, on wages, on labor, on consumption, instead of corporations and wealth. This cannot be the case this time. So that's why we're trying to put even more focus on the need to reform the system at this moment. And at the same time, as Peter was saying, one of the crucial elements is the lack of capacity in developing countries and the revenue authorities. But this is also a problem for the revenue authorities. If we put only the focus, the energy on increasing the capacity, the administration capacity in developing countries, for sure developing countries will be able to recover part of their tax losses that are foregone at this moment, but that will not be enough. And that will not be enough because the system is completely flawed for them. And that's the reason, in part, for BEPS. But the question, if it's BEPS 1 and 2, will bring the solution to that. So at the same time, we're working on creating this capacity in administrative capacity in developing countries. We need to also to make sure that we're working on creating the political capacity in those countries to make sure that we have the space for domestic reforms, but also to participate in the global process. So what is not working in developing in the international tax system? I mean, in many ways, the system has always been designed to protect the interests of rich economies, and in that way, all the system around tax transfer pricing has completely squeezed their capacity to really protect the interest of transactions happening in developing countries, especially because all the principles of the arm's length or the arm's length principle is just ineffective, inefficient, and out of reality. I remember discussing with one of the revenue authorities in Latin America. The international tax team was less than 20 people. They needed 2 people, 2 years time investing in an audit and tax in transfer pricing for just one company. I mean, when we really need to think that this has to be, I mean, for an amount of tax revenue that could be recovered, but very, very small, then we can understand that we cannot put only the capacities to react to this flow system, to this limited system, is completely insufficient. So what we would like to see is global reform. At the same time, we are investing in those capacity in developing countries that is developing this change in all those elements. What would that mean? I mean, first is what we've seen on the discussions around BEPS is that we put in on the table the right elements. We're talking about the need to review the taxing rights in a way that they go beyond the arm's length principle, which is at least a good assessment from the BEPS process. But for such a tiny portion of the global activity, that it will mean absolutely nothing for developing countries. We've seen also all this discussion about the global minimum effective tax rate, which is also very positively welcomed by developing countries. But at the same time, I mean, if Ben was saying that if the order rule is not making developing countries being able to recover first those revenues, and secondly, at a sufficiently high rate level for this minimum effective tax rate, that this is going to be meaningful, then what's going to be the purpose of this system? So it's going to be, for many developing countries, it's like a trap at this moment, because they need to invest in participating in all this process. They need to be active. And Peter was saying that the risk is that this is also diverting from the energy they can put at domestic level. And at the same time, the outcome of the process can be absolutely insufficient, because it's going to be more complicated, it's going to be more sophisticated, and it's going to be it's unclear if it's going to deliver the amount of revenues and the sense of fairness in the system that developing countries need. So what we would like to see is the capacity to change the system. It's a global process, it's a global problem, but it has asymmetric implications because developing countries are proportionally having more, but it has also an asymmetric power, a problem of power. Developing countries are not participating on exactly on equal footing, despite the existence of the inclusive framework. So if we really want this process to deliver for developing countries, we need a global reform that is based on multilateral principles, but it's also the design in a way that the capacity, the real capacity for the developing countries to participate is on equal terms. And for that, at least we need that we recover the idea of formulary apportionment for the entire revenues, that we are having this, we're developing this minimum tax in a way that developing countries can protect their interests first, and it's high enough to stop also the race to the bottom, the competition between countries, because we need to remember that this was one of the initial outcomes also of this process of BEPS. And third, that this digitalization of the economy is not also something that is only meaningful for rich economies. It's also going to change the business model for developing countries. I mean, all the e-commerce activities in Latin America has been the region where the e-commerce activity has been growing faster during the pandemic, and they are absolutely unable to retain most of the profits from this activity. So we need to make it simple. We need to make it less sophisticated. We need to make sure that we are not protecting some interest, some countries instead of the developing countries. We need to make sure also that this minimum tax is raised at a way that is high enough and to make developing countries countries being able to tax first. And at the same time, we need to protect also the capacity for developing countries to adopt unilateral measures, develop at national level in a more simple way for those activities that are not covered by the scope of BEPS, and in a way also that will allow them to move, to give a sense that it's not just a very, very small number of companies that are covered by this activity, while many others are out of the scope. I mean, the sense of frustration we hear from many countries still is high, and we hope there's still room for improvement. So we hope we'll see that happening this year. Thank you.
Thank you, Susanna, very much for your very interesting comments. Can I now turn to Alex? You have worked extensively on illicit financial flows. Would you consider profit shifting activities by multinational companies as part of the illicit financial flows? Should developing countries make unilateral changes to their tax regime to limit these outflows? And if so, what measures should you consider adopting? Alex, you have 7 minutes so that we can have time for taking questions from the audience. Thank you. Alex, floor is yours.
Thank you, Sanjeev, and for the invitation. Look, I'm using these slides as a drunk uses a lamppost for support rather than illumination, to do 7 points in 7 minutes. On that question, absolutely, corporate profit shifting is the largest element of illicit financial flows. And I'm very glad that last year, after a 5-year fight, we spent the first 5 years of the SDG framework with the target finally to reduce illicit financial flows, having to deal with a fight back from the lobbyists of multinational companies who wanted to remove corporate profit shifting from the definition of illicit financial flows. We now have a formal statistical UN definition for illicit financial flows that makes clear that corporate tax abuse in the form of profit shifting is a core element. So it's kind of great to have that argument put to bed in some sense. But I thought Peter's presentation was very interesting, and obviously raises a number of interesting and important points for lower income countries, in particular limiting interest deductions, introducing withholding taxes across the board, and looking at minimum corporate taxes, which I'll come back to. But I worry slightly that the frame, and I think Susanna's points have gone in this direction too, is really kind of looking through the wrong end of the telescope, that we are in some sense saying the problem that developing countries face with international tax is that they lack capacity or they haven't engaged enough, rather than perhaps thinking that the problem is that the countries that set the rules have no interest in helping other countries defend their tax base. And if we approach it from that angle, then we may see some different things. So let me run quickly through these 7 points. First of all, as I say, corporate tax abuse is the largest element of illicit financial flows, and also, as it happens, the one where we have the best, most robust estimates from the academic literature. Our very low estimate from the State of Tax Justice report is of $245 billion of revenue losses each year, but that's only for the largest multinationals, and it's a deliberately conservative estimate. As Peter mentioned, the IMF estimate is around 600 billion. Of course, if you look at all multinationals, this would increase. And again, if you look at the revenue losses that come from the downward pressure that this drives on rates, then again, you get a larger estimate. But even this estimate on its own implies illicit financial flows due to profit shifting in excess of $1 trillion each year. This is a first order global economic problem. And what we see once we're able to make that breakdown by country is that it's the OECD countries, and in the case of the UK, particularly their dependencies, which are responsible for the majority of those revenue losses suffered by other countries. This isn't a problem about some countries not being very good at dealing with the rules. It's a problem about a set of countries, mainly OECD members and their dependencies, setting rules that allow them to exploit others. Now, OECD countries themselves lose the most revenue, we find, by some distance, in fact. So there are losers in the OECD end also, indeed a great many of them. But it's lower income countries, that's low and lower middle income on the World Bank definition, who lose by far the most as a share of their current revenues. So OECD countries lose perhaps 5 to 8% of their current health revenues, their health, public health spending. Lower income countries lose more than half of their current health spending to cross-border corporate tax abuse. And again, this is on this more conservative set of estimates we're using. So that's who feels this most. But of course, the OECD countries are the ones that set the international tax rules. I don't blame, of course, Ben's colleagues for this, but I do blame the member countries of the organisation. Since the League of Nations' original decision in the 1920s and 30s to pursue arm's length pricing rather than a unitary system with formal apportionment of profits to where the real activity takes place, we've seen an expansion in the size and the importance and the complexity of multinationals, and with it of profit shifting. And our evidence shows that profit shifting has really exploded since the 1990s, becoming a much more significant problem for OECD countries and others as those rules become less and less appropriate to this phase of globalization. So where we are now is a position where the international tax rules simply are not fit for purpose. And that's what the OECD BEPS process carried out at the behest of the G20. What it recognises, the current stage starts from the starting point that the arm's length principle is no longer fit for purpose and we need to go beyond it. The argument is about how far we go beyond it. As Peter and Ben have said, there's these two pillars: a minimum tax rate to reduce the incentive for profit shifting, and formulary approaches to ensure that at least some profit is declared as for tax purposes in the countries where the real activity takes place. But of course, the current proposals don't go anywhere near far enough. We're under Pillar 1, the OECD estimate is that they would reduce between 2 and 5% of the current scale of profit shifting because the approach is both very complex, as Susanna has said, and also very timid, really removing very little in the way of revenues from the main profit shifting hubs, who, did I mention, are OECD members and their dependencies. So we have the situation where lower income countries, their proposals and views have been largely ignored or they've been sidelined. Even the African Tax Administrators Forum, who work closely with the OECD, have come out to express their great frustration about this and to say that only G7 voices have been heard. The G24 proposal that was on the table at the beginning was simply eliminated without any evaluation, despite the fact that the inclusive framework had required that it be evaluated. So we've seen that process kind of reveal entirely the lack of voice for lower income countries, and that's driven a great deal of frustration. But it's also given us clarity, I think, about where things go next. There are big changes coming down the pipe, and it's two main elements. The second of these is that we're going to see a lot of unilateral reforms by individual countries or by blocs, including outside of the OECD, but also most likely the European Union. One of the elements being discussed within that is our proposal for the meter, the minimum effective tax rate, which is a way of kind of combining some of the better elements of Pillar 1 and 2 to get a more substantial redistribution of taxing rights. But the bigger piece ultimately is this: we're going to see a shift from the OECD, from the rich countries setting rules for everyone, to a globally inclusive process at the UN. The FACTI panel has, for the UN systems report earlier this year, has recommended a UN tax convention, which would set some minimum standards of cooperation and transparency, making sure lower income countries are included, but also, importantly, set the basis for an intergovernmental tax body to ensure that tax rules are set within this globally inclusive and relatively transparent and democratic process, rather than at the OECD. So we may see some progress with the OECD process in June, July this year, and I certainly hope we do. I hope it includes elements of the meter proposal, which is being discussed, but that won't be anything near addressing the full scale of the problem, which, just to end, is of course fundamentally political rather than technical. It's about where the power lies as much as what the individual rules are. Thank you.
Thank you, Alex. Very interesting presentation, and I'm very thankful to you for sticking to your 7 minutes and making the points very clearly. I'm sure they will help us debate the issues in the last half an hour or so. Antonia, I'm going to turn to you. Could you please explain to us the approach that your department has followed with regard to tax and development, particularly in the area of international taxation? And of course, I'm not asking you about the views of the British government, but only of your department, which is engaged in providing assistance for development. Thank you, Antonia. Go ahead.
Thanks so much, Sanjeev. Thank you, everyone. Great to be here this afternoon in the UK time. So yes, to echo points that have already been made by many of the speakers before me, we think that administrative capacity building on international tax is extremely important. And so I plan to take you through how that fits in with our wider approach in FCDO on tax and capacity building. A few comments on our specific approach on international tax and the programs that we have in place at the moment in that area. And to pick up on a case that Ben mentioned, to highlight how long-term collaborative partnerships between partners like the OECD and others and partner countries can deliver really impressive on-the-ground results. So I'll give you a story of that towards the end. So our general approach as a department on tax and development is to focus on three main themes. The first one is to establish deep partnerships with the countries that we support. The second is to build progressive public finance systems because our goal is to reduce poverty. And then finally, to be as agile and flexible as possible so that we can make the most of emerging opportunities as they arise. So the FCDO perspective in this panel is really coming from the perspective of supporting effective international tax capacity building. As I mentioned, I'm glad to be joining the OECD on this, particularly because they're a key partner of ours in this work. And I'll go into that in a bit more detail later. So specifically on international tax, I think there are three overarching things to say from our perspective. The first one, as has been mentioned before by Peter and others, international tax is only one component of the domestic resource mobilization agenda in countries. And so international tax really needs to be balanced against those other domestic resource issues like VAT and all of the other areas. And it's important for it not to either take too small or too large a slice of people's attention. Secondly, as we've discussed, it's an extremely complex area. However, as has been alluded to before, it's likely to grow in importance in future. So for countries to protect their resource bases, we think that international tax is only going to become more important over time. Finally, again, as has been alluded to before, international tax is a long game. So really meaningfully improving capacity normally requires years of commitment on both sides between the partner country and the supporting organisation, but it can deliver really significant benefits in terms of securing and revenue. So now I'm going to tell you a little bit about what FCDO is doing in terms of programmes in this area. So most of our support goes through the RITI programme, which is called abbreviation for the Regional and International Tax Initiatives Programme. But the programme's got a total value of £35 million, and it currently supports 6 partners, which includes the OECD, IGF, the World Bank, the African Tax Administration Forum, the Partnership for Collaboration on Tax, and the African Union Secretariat. And the overarching goal of the programme is to help developing countries increase their revenues from taxation in order for them to become more self-sufficient and to deliver pro-poor public services and economic growth. Within that support, most of those partners provide capacity building on BEPS issues. I'm just going to highlight a few of those, and Ben is here, so he already knows all of this on the OECD stuff and is indeed in charge of leading most of it. But just for the benefit of everybody else and for the audience, The OECD work that's partly supported by FCDO with other donors does really important capacity building on things like BEPS implementation, for example, induction programs to the inclusive framework for new developing country members, also bilateral capacity building, for example, on legislative reform, as was mentioned before by Peter, getting that domestic legislation in place to be able to properly implement things like transfer pricing. Also, as Ben mentioned, work on extractives, often in partnership with IGF, which is our second partner there. IGF has got 6 deep dive countries where they really go into detail supporting taxation of the extractive sector in resource-rich countries. And one of those where IGF has worked very closely with the OECD as a deep dive country is Mongolia. And I'll mention a bit more about that later on. The World Bank and ATAF give peer-to-peer support on transfer pricing issues. And ATAF also issues some dedicated guidance on transfer pricing for their member countries in Africa. And the Platform for Collaboration on Tax has also produced some really impressive toolkits on BEPS issues, for example, on offshore indirect transfer of assets. So overall, that programme is designed to help developing countries navigate the complexities of international tax and BEPS, to engage with the international standards and to their space. I also should mention that separately, our revenue administration, HMRC, has got a capacity building unit which delivers peer-to-peer support on a range of tax issues, including transfer pricing. And they have support to 6 countries coming up over 2021-2022. So that's a whistle-stop tour through some of the support that some of the programs that we are very proud to support with partners, some of whom are represented on this call. So I want to just close by saying a bit more about that Mongolia example. So I should first say these are my reflections of the case that's recently been publicised in Mongolia, as not reflecting the Mongolian government's views. So there have been very attention-grabbing headlines about the scale of the revenues involved, and the scale varies depending on exactly which part you want to pull out. But according to my calculations, it's at least 1.6% of Mongolia's GDP, potentially more. Important caveat that amount may change because there could be further legal action, which means that we don't know what the final position is. But anyway, I think the main point that I wanted to make on it was, whatever the headline figures there, behind the headlines, there have been many years of work by the Mongolian tax administration and partners on putting together all of the building blocks that made that type of really big result in terms of revenue happen. And that included introducing the right transfer pricing legislation, as Peter mentioned before, creating a dedicated transfer pricing unit, all of the other types of anti-avoidance measures that they've done in recent years, working with the OECD, IGF and other partners like the IMF, and with bilateral Japanese support over a really sustained period to then get to this very impressive recent result. So what I wanted to close with was to stress that in the Mongolian example I've just mentioned, and in others that we could mention too, so Zambia, for example, it demonstrates making significant progress on capacity building in international tax is usually a long game, and it tends to be most effective where you have strong partnerships with long-term commitment between both the supporting countries, supporting partners and the partner country, as the Mongolian case has shown. Thank you very much.
Thank you, Antonia. And let me, before picking up some of the questions which have come from the audience, let me give the floor to Peter to respond to some of the points which others have raised. Peter, if you can pick up the key issues in 2-3 minutes, then we'll have some time for discussion. The floor is yours.
Thanks, Sanjeev, and thanks to all the panelists for the comments. I think what it shows in the discussion is that there is a broad range of views on these issues, and I think that that's been the case ever since this project started. You know, there are many different views. Just a couple of points I'd pick up on. One that Ben made around MTRSs, so medium-term revenue strategies. Sanjeev and I, it's something that we looked at last year as well. I mean, I think it is good that that international issues get picked up? Is that a part of a broader package so that countries can fit international tax issues within the broader priorities and list those priorities? I think the only challenge that Sanjeev and I have identified in the past is getting MTRSs from the point, progressing those. So they're often seen as a good idea in many countries, but actually getting them to completion is very difficult, and takes a lot of political will. The transfer pricing points made around Mongolia is a very interesting issue, and it would be great if they could be replicated in other countries. Recently, I've been in a few countries where the major multinational enterprises are all running losses. They're in sectors where it's very difficult to see that they're making losses, which would indicate that there is some pretty significant transfer pricing issues sitting in many developing countries. The minimum tax issue, I think that's a really good issue. Where you set that rate is a challenge, but I think that might provide scope for developing countries to collect some revenue. And I suppose the last point I'd pick up on is the last point made by Antonia, is that that it is a long game, and that it will take a long time for things to progress, especially for developing countries in this area. So thanks, Sanjeev.
Thank you, Peter, for very succinct response to the key issues. Now, let me pick up some of the points which the audience has raised, and the panelists, of course, have the option of also picking up some of the points that Peter just made. So, but keep your remarks to no more than three minutes, otherwise we run over time. So one of the issues which people in the audience have raised is, we all know about the drawbacks with tax incentives, and what can one do to limit these incentives among developing countries? And of course, we are getting into a political realm here, but it's an issue which Palin has raised. So I will ask the panelists the audience has raised, the panelists can pick it up. And what they're asking is, can there be an agreement among low-income developing countries to limit the use of tax incentives? And the second point, the audience which has been listening to this rather complex topic, they are asking the question, why spend time on complicated tax laws? Why not just have simple rules that everybody can understand and everybody can follow? And the third point that I thought, which was raised by Ben, and I think the panelists may have their views on it, is the extractive industries, where the progress has been of retention of profits in the countries have been pretty low. So that's the third point. And I think Peter picked up the issue of MTRS also, because so far in the last 5 years, only 2 or 3 countries have agreed on MTRS. So it's not something which you can view as a success way to sort of replicate across different parts of the world. And so I'll stop here. And these are the questions which, and if something else comes up, so let me turn it around. I'll go to Antonia first and do in reverse order, and she can pick up any of the issues, and then I'll go to the others after that.
Thanks very much, Sanjeev, and thank you to the audience who posed us those interesting questions. So I'll take the questions in reverse order as well. So starting with extractives. Yes, I mean, one of the issues I think with transfer pricing is that it's so important to have really detailed industry knowledge often in conducting those types of audits. And so, you know, in the extractive sector, that means that tax administrations will often benefit from having really in-depth understanding of the extractive sector in order to be able to pursue those cases. So that's one of the reasons why in our RITI package that I described earlier, we have support to IGF, which many of the listeners may be aware is an organisation specialising in the extractive sector and the particular issues around mineral pricing, the particular types of transfer pricing issues that you face in the extractive industry. So we are very much engaged in capacity building in that sector, but I think, you know, the Mongolian case probably shows that there's a lot further to go in sort of ensuring that there's more consistent compliance and making sure that tax administrations are equipped with that sort of the dual track of transfer pricing expertise, but also extractive industry expertise sufficiently. Then you had a question about why they're all so complicated. It's a really good question. I mean, it's a question that I've thought myself sometimes when I've tried to get my head around a lot of the kind of more arcane points. It is incredibly complicated. And I mean, you could probably write a really long thesis on the question of why is it so complicated and what could we do to simplify it. I mean, the best answer that I've heard to that question is really just coming from the pragmatic angle that quite often the complexity that's there is there for good reason. It's not that anybody necessarily wants the system to be complicated in terms of the people that design the rules, or certainly not usually. Most people are trying to make sure that the system is simple, but it's often there for good reason. So, for example, in domestic law, you might have layers of complexity simply because you have to have anti-avoidance provisions layered on top of your existing rules. And so that's some of what you see, for example, with the BEPS recommendations, which does add complexity, but sometimes that complexity is there for a good reason. And then finally, you had a question about tax incentives. So we could say on that, I just wanted to draw attention to the fact that the Platform on Collaboration on Tax has done some really interesting work in that space, compiling the evidence that shows that they have limited effectiveness. So I'd sort of signpost to anybody interested in that issue, take a look at the work that the PCT has done on that. And one thing I just add on tax incentives as well is improving the transparency of those incentives is also quite important. So in that way, citizens themselves can have a good understanding of the decisions that are being made, and then and understand how their tax money is being spent. Thank you.
Thank you, Antonia. Can I turn to Alex, please?
Thanks, Sanjeev. Just on that last point, I agree very much with Antonia. You know, I don't think, although there is a fairly strong sense now that you know the international norm is that you should be very careful about tax incentives and recognise just how much money is involved in a way that's often kind of under the radar. Transparency and scrutiny in Parliament is the key to empowering people rather than some kind of international rule that says you can't do this. We know that, you know, tax incentives have been a key part of the industrial strategy of most OECD countries over, you know, prolonged periods of time. We shouldn't be saying lower income countries can't do this, but we should be saying there is best practice on this. You know, and if I look at a country like my own, the UK, you know, the absolute absence of any scrutiny of the extraordinarily large tax incentives we have given to North Sea oil and gas over decades is shameful. And, you know, it shames our parliament and our government, and the fact that it hasn't ever been properly publicly scrutinised is, you know, an indication of the weakness. It's entirely, unfortunately, common to see that elsewhere too. We should definitely be pushing standards of transparency and scrutiny. But I think the other question I want to pick up on around both extractives and having simple rules. You know, on the one hand, it's true that this is a whole set of complex issues here interlock. And so, for example, in a very small piece, if you compare the Global Reporting Initiative standard for country by country reporting, which is, technically robust and really requires consistent reporting across companies and countries, with the OECD standard, which was very heavily lobbied to weaken it while it was being put in place. The OECD standard, in some ways, you could say is simpler, but it also completely fails to deliver consistent data. And Ben's colleagues in the technical department will tell you at great length about how painful that is, trying to deal with it and make sense of it. So we'll see a process of convergence for good towards the more complex GRI standard. But on the other hand, a lot of the complexity around transfer pricing is really an attempt to not do something simple that would be harder to game. And we've seen all of the multinational proposals for the OECD reforms at the moment, none of which, despite the rhetoric being around companies wanting simplicity, none of which deliver any kind of simplicity. What they deliver is complex and interlocking opportunities to game the system in different ways. In the extractive sector, Zambia is a great case where, well, a terrible case where, we've seen very clear tax fraud, not just dubious avoidance, but consistent fraud by major household name multinationals over prolonged periods of time. The response to that, or one of them, has been to require the price of the commodities, copper in particular, to be matched with global market prices, so to eliminate the transfer pricing manipulation possibility. But the complexity of transfer pricing rules as they apply to every other angle means that the companies have simply shifted their manipulations into management fees, intellectual property, intergroup financing, and so on. Only when we finally get to a system of unitary taxation, so taxing the multinational at the global unit where it makes its profit, not trying to say this much profit belongs to this subsidiary and this much here, by taxing at the unit of the global multinational, the group, and then saying the profit should be allocated as tax base in proportion to where the real activity takes place, do we get to the kind of simplicity that allows us to make a big step forward? And that can still be gamed. You can still pretend that you've got employees here when they're over here, for example, or that some of your sales don't really take place where they do. But it's much, much more constrained, and compared to the rules we have now that simply are not fit for purpose, either for OECD countries or lower income countries, that simplicity will, when we finally get there, which I imagine will be through a UN process, will be an enormous step forward.
Thank you, Alex. Can I now turn to Susanna, please?
Thank you. Let me start with the transfer, the tax incentives element also. I agree that transparency and the scrutiny is really the basic, the starting point. And that needs also this empowerment at the parliamentarian level. We heard from a Ministry of Finance in one of the developing countries saying that every year they were receiving requests for tax incentives that could go, if approved, beyond the entire budget of the country. So it's not the problem. We need this level of transparency. We need this level of scrutiny. So there are mechanisms to really review those elements and retain all of the ones that have some social impact. But the problem is going beyond that. There is a lack of political will because there is a lot of political capture behind tax incentives. And that's the reason why, despite lots of methodologies and cost-benefit analysis, we have countries where the review of those tax incentives is clearly setting. There is no reason for allocating this level of tax incentives. There is no social return. Those companies would be completely redundant. Those companies would be doing the same kind of investment even without the tax incentives, and still with this kind of analysis, governments are unable or not have the political will to remove them. So I think we need a global, we cannot estimate the capacity or the political will of those countries to review tax incentives without some kind of regional, sub-regional, or global of global work. So scrutiny and transparency is the first step, at least to stop this political capture. But beyond that, to really cut the negative effect, we need this global reform. And this is where we were expecting that the minimum, the BEPS Pillar 2 was going to deliver significant results, but it will really depend on the design of the design order and on the rate, because otherwise the level of tax competition will really not be significantly reduced. And that's very much linked to the fact, to the reason why we don't have more simple rules. I've been asked by many, in many countries also, why all this BEPS process, why all discussions on Pillar 1, especially because it's clearly more and more sophisticated and complicated, while something like some of the mechanisms adopted by some countries, withholding taxes on digital taxes, can provide in a very simple way at least the same amount of revenue. So why all that for something that is not delivering enough? I think it's not that it is complex, it's that we are making it complex. We, the international community, especially governments and institutions, because the problem is, there is a strong consensus around the problem, but when the problem comes to the table, then it needs to be negotiated. And on this negotiation, then we need to put the interest of some businesses, and then we need to put the interest of some countries. And when we try to accommodate all those interests, business and countries with more power than others, then we are adding layers and layers and layers of complication, because we cannot have one simple solution that is the simple one that could be for developing countries. So I think it's, many developing countries have been putting some of those solutions on the table, and it has been put aside sometimes because of the need to accommodate to the interest and the power of business and countries. So I think it's, every time we're talking about anything that is about corporate taxation, this is political, and what we need is at least starting with transparency, with accountability, to make it, to put it in front of citizens, to make all those governments and institutions accountable, and from that we need a process that we are on equal power, really.
Thank you. Thank you, Susanna. Ben, you have the last word. If you can make your comments in 3 minutes, then it'll give me 1 minute to summarize and conclude the webinar. So Ben, floor is yours.
Sure, thanks, Sanjeev. I hope you can hear me. I've had terrible connectivity problems in the last half an hour, but you seem to be able to hear me now. I'm on a phone. Yeah, three quick points. I think most things have been said on simplification. Developing countries in the current negotiations on digital and the global minimum tax are crying out for simpler measures. So we're taking that very much to heart in everything that we're doing going forward, and hopefully the results will become apparent in July. But issues such as profit allocation and the simplified approach to fixed returns on so-called amount B, these are a step forward in that direction for sure. On the extractives point, I think most things have been said, but as I said earlier, I think the international response is weak and much more needs to be done. And for those of you watching who have control over ODA and aid budgets, the fact is that from the audit results that we get, you get a return of at least 100 to 1. In other words, the cost of undertaking audits delivers at least $100 per $1 spent. And that should encourage those of you who have control over ODA in these difficult times to direct resources in that direction. And then on tax incentives, yeah, we're very much hoping that Pillar 2 will delete much of the current chaos on granting tax incentives that do not deliver investment. So I think that is a game changer. In the meantime, the transparency agenda is the way forward clearly, and all of the points that have been listed so far: public statements to Parliament, cost benefit analysis, tax expenditure reviews, consolidated reporting by the Minister of Finance. These are clearly good practice, and I think there's a kind of growing consensus. These are the basics that need to be done. Let me leave it there, Sanjeev. Thank you.
Thank you so much for sticking to your time. And so this brings us to the end of our webinar. And one of the things which I would like to emphasize is that we've sort of discussed whether one should be paying so much of attention to international taxation and perhaps focus more on domestic taxation. I think one cannot take the eye off international taxation because they do generate substantial amount of revenues at this juncture. And as I said, the COVID-19 has changed the picture going forward in the sense that revenue to GDP ratio in number of countries, all the developing countries are down by 2 to 3%, and it's going to take a number of years before they recover. So you cannot afford to lose taxes, tax revenues in the coming years as the overall revenue situation has worsened. And we also know, as I said earlier, from the experience of 2008, 2010, that when there is a crisis, the tax compliance is hit very badly. And so one would expect going forward, the revenues to be lower because of reduced tax compliance in the coming years before it sort of goes back to the normal level. So, so what is the key message that comes out? I think a number of messages that people have given to us here. One, it's important to have simple taxation if we can get there. And it's, I think, virtually all of you agree, it's a political process. And it's not going to be easy. Whether it's going to be OECD or the UN, we have to see what would eventually lead to this, to a simplification of tax system. But the point is, these taxes are not unimportant. They are important for the developing countries. And of course, transparency in the regard to tax incentives is important. And I totally agree with Ben that this has to be seen in the context of the overall debate, which is quite widespread in the area of tax expenditures, which if you start looking at some of the countries, they amount to almost 5 or 6% of GDP. And eventually, this is also something which has to be seen in the context of domestic resource mobilization. With these words, I'd like to thank the panel for an excellent discussion, Peter for very good presentation, and my colleagues for running the show. Thank you so much, and thank you. Bye.